The proof you've been waiting for that bonds don't grow. There are no capital gains in bonds. Oh, man, I tell you, I've been saying this for years and years and years, and some more of the, I guess, the well-read advisors have as well. There are no growth. There is no growth in bonds. What you get with bonds are income and income only, and I'm going to prove it to you once and for all. I don't even have to get on my little whiteboard, which I've done before. I don't have to tell you, cite another article, which I've done before. I'm going to show you the proof positive. It's a little bit serendipity, if you will, as well, because the evidence I'm going to show you is not related to bonds. Actually, it's related to fixed index annuities. And the guy was using this evidence to promote fixed index annuities. But if you look at the article, you say, there's the proof that bonds don't grow. It's stunning, actually. All right. So welcome to Heritage Wealth Planning. If you like what you see, subscribe, my friends, subscribe. Don't forget to give me a thumbs up. Of course, helps out with the YouTube algorithm. Share the videos with others. And as always, just comments are welcome as well. So let's dive right into this. I think I lose my mug when I go on to this PDF. Yeah, so you don't see me, which is probably good. All right, so here we got my man Roger Ibbotson, and if you're not familiar with Ibbotson, that's fine, but Ibbotson is well known in our business of financial planners because he's been producing this chart right here for many, many, many years. The Ibbotson growth chart, I can't remember what we call it anymore, but the stock bond index yearbook. I can't remember what it's called, but it's the SBBI. I forgot what it's called. But anyways, Roger Ibbotson, here is the man right here himself, a PhD. He is a emeritus professor over at Yale. And I've been following Ibbotson since I've been in the business. And I've been following him when I was in college in the early 90s too. So I want to read you some of the basis of his stuff here, and then we're going to get into the crunch time of what I was talking about, how bonds don't grow. Does not mean bonds shouldn't be part of your portfolio. Doesn't mean that, but do not think bonds grow in terms of capital appreciation. There are no growth there. So a review of conventional wisdom. Exhibit 1 shows the performance of large cap stocks, long-term government bonds, U.S. Treasury bills, and inflation since 1927. Over the long term, stocks beat bonds by a very wide margin. It's not even a contest. If risk were not a consideration, we'd all allocate solely to stocks. And as you can see here, stocks haven't even doubled the rate of return of bonds, but a dollar invested in stocks in 1926 or 27 is worth $5,407. Whereas a dollar invested in bonds is worth $125. It's literally that simple. A dollar invested in T-bills is worth $20, and a dollar invested in inflation is worth $14. So basically, your T-bills just barely beat the rate of inflation. Your bonds beat the rate of inflation. Of course, this doesn't factor taxes, and your stocks dwarfed it. So going back to the dawn of the modern era of stock market, I mean, I think most investors know this. Stocks beat bonds handily. Now, a lot of people don't realize that tiny little number there, 10 to 5.5, it just widens and widens and widens each and every year. It's interesting how that happens, simply because of compounding growth. I mean, compounding over time, which is one of the reasons I don't like fixed index annuities, because part of that 10% growth is the dividends, and fixed index annuities don't have dividends. Of course, as we age and approach retirement, risk is a major consideration. And here he's just looking at the annual returns for stocks. You see, 1930s, the war, 1950s was great. We got 1973 and 74 there, a couple of down years. And I mean, you can see here, boing, we got down, up, down, up, down, up, down, up, down, down, up. And you see how that goes. Then we had the late 90s run until 2001 and 2. Then he had 2003 until 2007, then a huge drop in 2008. And of course, last year in 2017, the market, well, I think it was down just a tad, if I'm not mistaken. I forgot. So that's the volatility of stocks. And here's the volatility of long-term government bonds. Not much. You got 94 right there, 99. I think that's 99 right there, 94 right there. I can't remember, but 94, 99. And you got a couple years here as well. And that's just simply because as the rates go up, the volatility of the bonds goes up as well, for sure. All right. So where do we go from here? Real quick, anyway, look at the difference. Not very much volatility on the bond side relative to the stock side. We're talking 40% here on the stocks. We're talking, I mean, not even spitting distance of 20% on the bonds. So that's what happens. The stock's more risk and a whole lot more return. As we see in Exhibit 3, bonds have done very well over the past 10 years, almost matching large cap stock returns from 2007 to 2016. Now, this does not take into consideration 2017, which is a great year for stocks, or 2018, which was not a good year for stocks. I don't think, but I know it wasn't the end of the year badly. So I think the market was down for the year. Anyway, so 2000 in the 10 years, 2007 to 2016, the stocks are up 6.95 and the bonds are up 6.48. Now, the bonds did have a lot more risk than typical. I mean, look at that. Typically, they have a whole lot less risk than that. Stocks had roughly the same risk they've always had. So the 10 years, stocks were up 6.95, bonds were up 6.5. For 90 years, stocks are up 10 and the bonds are up 5.5. And stocks had twice the risk as the bonds. There's just no two ways around that. The last 25 years, stocks are up 9.15 and bonds are up 7.52. Now, so you can see that bonds look like they're overtaking stocks relative to performance, right? Let's see. To develop a simple forecast for stock and bond returns, we can look in more detail at what has happened in the past. Specifically, we can decompose stock and bond returns into capital appreciation and yield. Capital appreciation is growth. Yield is income. Exhibits 4A and 4B break down total return for large cap stocks and long-term government bonds into income return and capital gain, i.e. appreciation. In the case of stocks, total return is driven by both capital gains and income. That's your dividends. You miss the dividends, you're missing a big significant part of your return. In the case of bonds, total return is dominated by yield or income. And here we go. You ready? Stocks, total return. So we start with $1 in 1927. We have 5,407, of which 166 of that is capital gain, and 33 of that is income return. The 33 would be the dividends. Now people say, wait, that doesn't add up. No, it's the nature of compounding. So even though we have 33 relative to income, 166 relative to capital appreciation. When that compounds year over year over year over year, getting these two things compounding on top of each other gives us that huge wide gap in terms of total return relative from where that return comes, capital gain or income. But if you look at it, so we just we have a 33 divided by 166. In this case, 20% of the returns of stocks going to 2016 have been derived from dividends. So 100. You can't really say but in some ways you can. But basically, we're saying dividends have attributed to at least a fifth. It's actually about 35 to 40%, but at least a fifth of the total return of stock returns. That's what it is. So capital gain, about 75% has been attributed to capital gain or so, and about 25% dividends. And I think it's actually a little bit higher if you look historically, simply because dividends played a bigger role. But anyway, that's how we were looking at that. Growth in long-term bonds. Total return, so $1 grew to 125, of which income represented $81 and capital gain represented $1. That's it. So capital gain give us $1. In fact, if we look here in the 70s, when we had inflation all the way up until basically 1999, we had a loss in terms of capital appreciation. Then we just simply picked that back up. So essentially, long-term bonds have given us no gain whatsoever. The bulk of the vast majority of the return of capital of long-term bonds has been solely from the yield or the income stream. I cannot stress this enough. Going back to 1927, right there, a little bit of capital appreciation, a little bit of capital depreciation, a little bit of capital appreciation, and it's going to be a little bit of depreciation as well as the interest rates rise again. It's just, there's no getting around that, and he'll show us in this chart here. If we look, Exhibit 5 shows the decomposition of total return for large cap stocks and bonds since 1927 and for the past 10 years. In the case of large cap stocks, total return is driven by both capital gains and income. We also took note stock returns for the past 10 years have been lower than they have for the past 90. The picture for bonds, however, is different. Long-term total returns for bonds are dominated by income or yield. In contrast, over the last 10 years, 45% of total return for bonds is attributed to capital gains. And this is because rates declined. I cannot stress that enough. Rates declined, which gave us a quote-unquote capital gain, But there is no capital gain because if you bought the bond 10 years ago, it will mature for par. That's all there is to it. There is no capital gain. I had a guy on my YouTube channel yesterday saying, well, if you sold the bond for capital appreciation, you could, but you still got to go in the market, and you're going to go in the market for a lower yielding bond. So it's all a wash. There's no other way around that. The recent level of high capital gains for bonds is simply inconsistent with long-term results. In addition, we note total returns from bonds over the past 10 years have been higher than their long-term results. So all that says is, look, we have an anomaly, if you will, on bonds simply because the market was reducing interest rates, and that gave the bonds a fake return. There's just no other way around that. And again, if you're thinking about, I'm going to take the capital gain from the bond and I'm going to use that to invest in another bond, this doesn't show you that you can't do that. I mean, you could do that, but you won't. You're going to sacrifice, let's say, a 4% yield and turn around and get a 2% yield. So I cannot stress this enough. It's a wash, a complete wash. And this doesn't reflect it. So the capital gain only is on the sale. So if you're to sell and pay off a house, that's great. I mean, without question. But if you're selling the bond and assuming you're going to get capital gain and be able to reinvest that in something else, like a stock you could do, it's just not happening. So from 1990 for the last 90 years, 5.51% of the total return of bonds has been from the total return has been 5.51, where income is represented 5.2% of that, and capital gain is 0.31. That's it, nothing. Over the last 10 years, 6.5 roughly is the total return of long bonds, whereas 3.5 is from income, the yield, and 2.89 is from capital gains. Again, it's just a fake anomaly. And if we look at the yield of current long-term bonds, we're looking at about 3.5%. I can assure you that's all you're going to get going forward. You're not getting more, you're not getting less, because the bonds will not go bankrupt. You're getting about 3.5% on the long bond for 30 to 40. For 30 years. They might. I don't think they're paying 4. I think about 3.5. On the other hand, with total return on this is what I was talking about. Yeah, so total return on stocks, 40% has been on income, on dividends. So just like I said, actually so 40% of the total return on stocks has been from dividend reinvesting, and 60% is from capital gains. Lately, the last 10 years, only 7% total return on stocks. And again, we have of that return, 40% has been on dividends, and roughly 4.5% has been on capital gains. Isn't that interesting? And then we're going to go back here. Today, yields are at near historical lows. At the end of 2016, the long bond was at 2.72. And again, I think right now it's at 3.5. The intermediate term government bond was even lower at 1.85. Let me check my trusty screen here. And right now it's at 2.63. For bonds to continue to enjoy the same amount of capital gains going forward, yields would have to decline significantly. It's very unlikely bond investors will realize a high return from capital gains in the coming 10 years as they have realized in the past 10. It's not going to happen. In fact, if rates rise, capital gains will be negative capital losses. I completely agree with that. And then we're looking at the intermediate term bond yield. Here's a median right here. And so then we're looking at the current yields, which are way, way, way below the median. So when you have a yields up here and the rates are dropping, that simply means the price of bonds are going up. So from 1980 to today, it's been a wonderful time to be a bond investor. No other way around that. From this stage right here to there, it's been a horrible time to be a bond investor in terms of your appreciation or depreciation, because the yields are going up, the price of bonds are going down, but now the yields are going up. You're getting a whole lot more bang for your buck. So if you bought this 30-year treasury right here in October of 1981, 1982, excuse me, a 30-year long bond in 1981, you were getting 15.25%. That sucker matured right here in 2012, and it was only paying 3.25. You got 15.25 right here each and every year with no risk. It just stayed there, stayed flat, boink, 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 boink. You sold it, actually got matured, got called away from you, and you had to reinvest at 3.25. That's not capital appreciation. That's just income. Your income your returns on that bond came solely from income. That's the only way it works. And then this is where he talks about fixed annuities as an alternative. All right, so I'm not going to get in that, but his premise is actually right. I like it. He's saying, look, at the end of the day, Fixed income annuities give you a good alternative because the bond rates are so low that you might want to look at a fixed income annuity, a fixed index annuity. And look, I'm not here to debate that, but I get it because the rates are low on bonds and they're going to be low for a long time. The facts that capital gains have attributed so much to the growth of bonds in terms of your portfolio, the way it looks on paper, a lot of people assume that can go forward. It just can't. Bonds have no appreciation. It's issued at 100, it matures at 100. In between, you get a yield, 4%, 4%, 4%, 4%. The only way that changes is if it goes bankrupt, then you lose everything. That's it. There's no other way around that. The only way that bond that is issued at 100, that matures at 100, changes its rate of return at 4% is if it goes bankrupt. There's no other way around that. And so the only way for you to make money is get that 4% yield and collect it. There's no other way. There is no capital gain or a capital loss other than potential for capital loss by the bond going bankrupt. I hope that helps. Remember, as you're investing in bonds, you're not getting similar appreciation to stocks. 5.5% in long-term bonds is not 60% of the performance of stocks. It's not 5.5% with no compounding is a whole lot different than 10% compounded interest for stocks. And I just showed you the difference is enormous. And after this video, I'm going to show you the American funds, the Income Fund of America, the Investment Company of America chart. They have this wonderful chart that shows you the impact of dividends. I've shown it before, but I'm going to show it again because it's critical for you to understand. All right. Thanks for being on board. Don't forget to subscribe down below. As always, you find value in this. You want to donate to the cause, go to Heritage Wealth Planning right here. If you scroll down, you'll see a little donate button on the bottom of every single page. Feel free to do that. Subscribe, share the video, and we'll see you next time at Heritage Wealth Planning. Thanks, guys.